Hello, investors. Welcome to my channel, Sense 360 Investor, where we look at trading from a 360 perspective. Today, we're going to look at a special topic, and it kind of cuts across both trader and equities to a large extent. And we're going to look at Silicon Valley Bank. So, this is in the news quite a bit over the last couple of weeks for obvious reasons. But I want to focus in on as an investor, looking at Silicon Valley Bank, how you may have got caught up in it if you were a buyer of it, or by looking at some fundamentals, how you may have avoided it and saved yourself a big headache. So this is the splash page on Silicon Valley Bank's website, and it's kind of useful because you really have these three core pillars: startup banking for early stage startups, because they are in Silicon Valley and they pride themselves by associating themselves with startups, and venture capitalists, which is the second stage as the rounding stages come on, go through the later um, funding stages. And then hopefully if the company does make it and gets there, then they'll continue to bank with Silicon Valley Bank as a late stage company. So it's a nice little flow in terms of their business model. And here is the description of the company, a business description, and kind of what stands out is treasury management up here, and then just how they raise their capitals and stuff like that, which kind of is put. If you want to dig into some of the reasons why the hiccup, then you would want to focus in on those two segments. But you can pause the video and read through this. Okay, so before we get into the thrust of this, just a quick word about the disclaimer. This channel's not providing financial advice. Please pause, read, and then continue. Thank you. Okay, so without much further ado, on with the show. All right, so let's have a look at a few charts first. This is Silicon Valley Bank monthly going back from 2005. So it's a very long view, and we can see overall an upward trajectory. Had a little issue in 2008, financial services, but for the most part, it's kind of trended up with the occasional pullbacks. And then we can see that the most recent run was out of character with prior peaks here, and then obviously stock falls off. And we'll also take a quick look at Signature Bankers since they're kind of in the news as well. So this one didn't do much for, even throughout the Great Recession, didn't suffer much. They had a nice uptrend for many years, then didn't do anything in a long time, and then all of a sudden in 2020 COVID era, stock takes off, and then before it flames out again. And so we look at Silvergate. Silvergate's more of an IPO, nice little IPO out of the gate, tremendous run, and then tops out. If you overstayed the party, and obviously he was zeroed out pretty much. In First Republic, so this one has the kind of the most gentle chart of all of them. Nice little uptrend. Again, we can see a kind of a climactic move through there, and before it gives up the ghost and then collapses. Okay, so if we look at Silicon Valley Bank, back to that on a weekly basis, and we zoom in a little closer, so we can see that it didn't do anything through this period, and then we have the COVID collapse there, and then as with everything with QE and all the money printing, the bank does extraordinarily well. Has a nice uptrend move here, a lot of momentum. Then it falls into a consolidation, and on 5/21, 2021, there's a very popular list of stocks that are published on a weekly basis, and you can see that Silicon Valley Bank ranked 5th out of 50, as this stock had already made this run and was now in this consolidation phase. So it would have broken out of that phase and made this move. If you hung around too much, you would have then obviously given it up the ghost. But it's definitely, there was a tradable entry, and this newsletter called it out. All right, so if we come in a little bit closer onto the daily, we can see that for pretty much it's on late 2021, stocks just been in a downtrend um, all that time. So if you were thinking about it, you're either looking to play this as a value play, um, or you're looking to see how you can avoid a falling knife. So let's move on. Um, this gentleman here, the name is James Cramer, Jim Cramer, is also has a TV show on CNBC. In fact, very controversial. There's now an ETF that is banks on the inverse of his stock picks. So this is just recently launched in March. There's also a long side, but it's the short side. As you can see, since this has come out, the short side has actually moved up, whereas the long side has moved down. So there's a lot of people out there that like to do the opposite of what he says. But there's a reference to a video on YouTube which you should take a look at, because he is really pushing. He's a Silicon Valley Bank stock bull, and you can watch all his calls, and pretty recently as well, before the thing went belly up. Then after the fact, CNN has this really nice little YouTube clip here, which actually explains some of the reasons why Silicon Valley Bank ended up the way it did. So if you want to understand some of the financial or fundamental reasons, I suggest you take a look at this YouTube video here. So this will give you both sides of a balanced view. All right, so let's have a look at some sentimental and some websites that you may have looked at. So this is like Yahoo over here. So if you were just looking at Yahoo on Silicon Valley Bank, your eye goes to here that the stock's undervalued, and by the time it's fair value or matures, you can make 54% return. So what's not to like about that? At this stage, stock had come down to 106. So this was after one of its early falls. And the 1-year target on the stock was 250. So we're basically looking to go from there back up to 250. And then over here, we have another website. And so they have a fair value of 243, which is pretty close to the 1-year target here. So that corroborates. And the bank is no moat. And so they're also saying that when you buy it up here, you're getting a 56% discount. So again, people looking for a bargain with the classic cigar butts, as Ben Graham would say, this would be attractive to them. So you can see why Jim Cramer would be gung-ho about picking this up. All right, so let's have a look at a little bit more on the sentiment side. So here is Silicon Valley Bank, and these are trends based on analyst ratings. So you can see the move from December to January to February to March. Notably, in January and February, there was no sellers, but a couple of people had underperformed. And then we see a drop in the number of analysts, goes from 24 to 23 to 19. So we probably saw one of these or both of them drop out of this ranking because the underperform goes away. But there are no sells at this point, right? So none of these analysts are saying sell. So there's like a hold, buy, and a strong buy. So these are pushing the stock. The aggregate score is meaningless. We want to take a look at that. But also on the same page, you can see some of these analyst companies. So here you go, like Piper Sandler moved it to a buy, and Wedbush to a neutral. So to overweight, to market form, to hold. So none of them here are looking at a sell on the stock. So you look at this and it's easier to say, hey, the analyst community is okay with this. And there are some more, and then you can see buy. Only one had held, which is Jason Goldberg of Barclays, but everybody else is buying. So here we got not only they're buying, but they're reiterating their calls as recent as 7 days, 12 days, 17 days, and the upside on the stock. So they have it at $300. So from the price at the time, upside is 182, 194. So quite some significant upside price targets. And so here is some more ratings. So you've got 16 analysts in this group, and out of the 16, 7 of a buy, 7 of a hold, and here that we have 2 that are to sell. So obviously these 2 um, had some information that the others didn't. All right, so now let's take a look at some basic tenets. And um, so rather than looking at websites, free websites, etc., if you had a disciplined approach and you did a little homework, what conclusion would you come to? And as part of that, we'll touch a little bit on quality balance sheet and technical strength along the way. So without doing a deep dive into a full-on stock analysis, we just looked at like a couple of key fundamentals, right? So this is pre-tax profit as percentage of sales, right? And this is a 10-year view. So we can see that, they had a pretty good margin back in 2013, and they had been coming down because obviously margins at this level are difficult to sustain. Then they kind of dropped into this margin around 40%. They picked it up a little bit, big drop during COVID, and then we get the rise after the QE. But at the end of kind of QE, and after this started to disappear, you can see that the margins have been coming down, right? So this is a huge red flag. That by itself is really enough keep you away. And this draws in the last 5 years, so you can see it a little bit clearer. And you can see that in June 2021, there was peak margin, and then since then they've been coming off quite a bit. In fact, they're now lower than they were during the COVID low. And so this is just looking at the on a 4-quarter trading basis in terms of pre-tax dollars that were converted to a percentage amount. So this is the COVID era, and you can see continuation instead of a quarterly 4-quarter trading quarter basis, same picture. So this is confirming what we already know, that the margins are shrinking, and there's some fundamental issue that management isn't solving, because you don't want to be entering a company with this kind of look. All right, so if we looked at valuation measures, which is another popular way many people take a look. I mean, just a couple of lines here, and the top line itself tells a story from 21 through to 22. These are quarters. So you can see 39 billion, 32 billion, 23 billion, 19 billion. So the trend, the capitalization is just decreasing. Trailing PE the multiples are also coming down, which somebody can take a look at that and say, oh, it's an attractive valuation. And then if you look at PEs, I mean, forward PEs have been coming down significantly as well. So it's not, it's kind of at a stage where you're in a trough and now you can recover back to these levels. Quite a bit of work ahead. So this doesn't look, and even price to sales is another valuation measure. So especially when a company doesn't have earnings, you can look at this. But you can see this has been deteriorating all the way. Price to book, which is actually a bit more applicable to banks on valuations, you can see this has been coming down. So there's nothing good that's showing on this table. If we look at the P&L, the income statement, so the one star here is that the revenues are showing as improving. So that's actually a good thing. So the top line, they're actually growing, even though their price to sales was coming down. Then we can see that pre-tax income, and this is just in dollars and thousands. So we can see this is about roughly half of that. This is slightly less than half of that. And again, slightly half that. So you can see the margins, or pre-tax income itself is kind of deteriorating a little bit. And so if we go on to the balance sheet, and here we can see that while assets are kind of growing, liabilities are also going up. So there's something funky going on with their debt. And then capitalization, which is the balance of assets and liabilities, is moving up, which is good. tangible book value is kind of up and down, but the notable thing is net debt takes so that this is quite a bit, $5 billion, whatever that is, which we don't have before. So some debt's been taken on. So that needs to be investigated as to what the purpose of that was and why they needed to do that. And then if we look at the cash flow statement, a couple of things to note are in 21, this financing cash flows. So it looks like $85 billion came in, and they've got this investing cash flow of 90 billion. So what was all of that about? What happened here? Because this is an outlier compared to all these other numbers. So a little digging here needs to be understood as to what was going on at the bank that this was needed to have been done. And then so they're buying back some stocks. Fine. All right. So another, if we take a look at this another way, so we can see here that in the quarterly financial history, we can see the quarterly changes in between these two quarters. Pre-tax profit dips 30%, 32%, earnings per share dips 25%. So here, if as a growth investor, this certainly would not fit your profile. And even as a value investor, you would be then looking to see if the company can turn it around. But as we saw with the charts on margins, the management's had multiple quarters where they could have done something and they haven't turned the ship around. And so this isn't 23, about 390, 600, 501, so 731. So sequentially they're coming down and up. So not good. And then here we have some more analyst views in terms of what their position was. So a few of them have buys, a lot of them are neutral. Only one, Argus, has sell on it. Okay, so this is an excerpt from Value Line from February 3rd, 2023. I'm going to read this now. You can read this by pausing the video, but it's kind of interesting here. Companies' credit and financial measures have taken a step back. That's an understatement right there. And this was funny. Financial is best suited for patient investors that can tolerate some uncertainty. So that's quite an understatement given what happened. But over on the same page, this is quite interesting. Institutional decisions. So this tells us how many institutions bought the stock and how many sold stock. So we can see that in the first quarter 22, there were more net sellers. In the second quarter, more net sellers. In the third quarter, there's more net sellers. So it begs the question here: if there are more net sellers in with these 3 quarters, then why didn't the analyst sentiment on what we saw earlier reflect that? And why aren't more people negative? That showing on those charts, because this chart here clearly tells us that the actual sentiment, as opposed to the sentiment we saw on those website pages, is pretty negative. I mean, you've got 3 consecutive quarters here where the institutions are basically net sellers. And if you didn't want to do any of that work and we just looked at the technicals, we can see how the stock from here, 21, whatever it was, is actually just been in a downtrend, and then you've got the infamous golden cross or death cross there. So you definitely don't want to be in the stock after that period. But if you were a short-term trader in this, there was a couple of opportunities. One very recent up here, which was a short sell signal, and then if you had sold a stock short here, you can see you would have been actually been tall clover, because you would have gotten in ahead of the palaver and made off like a bandit. So the evidence here shows that just a little digging with a little discipline and a little knowledge of how to read financial statements, and even just by looking at the charts, would have saved you from following the advice that somebody who's got a lot of influence, like Jim Cramer, it would have kept you out of the stock from the long side. And in fact, and then if you subscribe to do the opposite of what he tells you, and you'd be, instead of going long Silicon Valley Bank, you'd be looking to go short Silicon Valley Bank. So then you're looking for a short, and so you could have actually had the short up here around 260, and you would have benefited like a bandit. So kind of interesting. Okay, so that concludes the update on the rise and fall of Silicon Valley Bank. I hope you enjoyed this video. It's a little bit different setup today. If you're not a subscriber, please do subscribe. If you like this content, give it a thumbs up, share with your family and friends. If you want to leave a comment, please do so. That wraps it up for this video. I will see you in the next one. Thanks for watching. Thanks for listening. Goodbye.